A very good evening to everyone. Hello, everyone. And last week I promised that this time we are going to have the very first session that we've ever had around debt investing, or rather fixed income investing. And I promised you guys I'm going to have a very interesting guest with us on the show. And I couldn't think of a guy other than Mahendra Jajoo, who is the CIO fixed income of Mirae Asset, help us start with the series on debt investing. So, yeah, Mahendra, a very warm welcome to the Fisdom Wealthcast. And incidentally, this is the inaugural session on fixed income. So, you're our first guest when it comes to debt investing. A very warm welcome to the show.
Thank you so much, Nirav, and it is my privilege to be here and happy to know that this is the first session on debt, so that much more of a privilege for me.
Absolutely. So, in fact, Mahendra, I feel there are a lot many questions that people are having around debt. But let us start with the fundamental question. Everybody knows about equity, and yet there is another, world that keeps talking about the importance of fixed income and debt. Right now, for a common investor, the terminology fixed income is highly misleading. Okay, people feel that fixed income investing is all about investing and earning safe returns. They try and equate it to other traditional instruments like fixed deposits, but we know that's not the case. So would you like to touch upon how is debt slash fixed income investing different from equities, and how should an investor, what should an investor take note of, an equity investor take note of while investing into debt for the first time?
So, thank you once again. Let me just start with saying that we are a fund manager under the SEBI regulation. So, therefore, whatever I speak on the discussion today, please read it with the disclaimers and disclosures in our scheme of documents and the website. Now, when we talk about debt, obviously the financial markets in India are evolving at a very rapid pace. And therefore, what we historically thought about debt or how we looked at debt is obviously going to change. And when we are interacting with investors now or the advisors, experts like your team, we are now understanding a clear feedback of wanting to know more about debt. Now, there are two things when we talk about equity investing versus the debt investing. So there's a common term, investing. So I think the investing part pretty much remains the same. So the conventional techniques of asset allocation, etc., remains the same. There isn't much difference when you talk about the investing part. Now obviously equity and debt, generally, we when we say these are two different asset classes, but they are part of your wealth creation process. The one thing which in my view leads to the entire confusion or the entire misunderstanding is just one basic change in approach or the thought process. When people talk about equity, they think about maximizing return and on a yesterday basis. But when people talk about debt, their overwhelming emotion behind looking at debt is capital preservation, right? And when you talk about investing, your object should always be maximizing your return, obviously, within the framework of risk management. And therefore, when people look at debt, they are so fearful that they just confine themselves to the traditional uh, options of a bank FD or something. If you look at the debt mutual funds, they have proved to be very attractive over a long period. Now, mutual funds have been in India for about 25 years now. And if you look at the long term return of the bond funds, it is somewhere close to double digits. And the in terms of the risk perception, there's a huge gap between what the reality is and what the uh, perception is, because there isn't any bond fund which has given negative return on a rolling basis for more than 1 year. Very infrequently, I think there are a couple of instances, and interest rates go up and down. Now, therefore, I think as the investor education standards improve, as the awareness about the debt improves, as the desire to maximize return without compromising with the risk improves, and especially when we look at the change of generation, because there is a certain prejudice, there's a certain set pattern with the old set of investors, but when we look at the young people, they are very open to new ways. Now, you might be wondering why I'm spending so much time talking about the general features and not going into specifics of debt versus equity. I think it's important because the bottleneck is here. People understand the technicalities very well, but then, you know, as we say that investing is 80% about emotional and temperamental control and 20% about intelligence, because everyone is intelligent. But when it comes to debt, people don't set their objectives right. Now, let me give you a small example that when people talk about debt, most often when you interact with your clients, or when I, as a fund manager, interact with my advisor friends or distributors, the most common response is that, look, why for 1% extra return I should take so much risk? Now, you think about it, if you invest 1 crore for 10 years and you make 1% extra, right? You make 10 lakhs extra in a period of 10 years. Over a period of 20 years, you make 20 lakhs extra. Over a period of 30 years, you make 30 lakhs extra. And then if you put in the effect of compounding, it will be possibly closer to 35 lakhs. Now, 30 years I talk about because 30 years is the typical investing life of an average investor. So if you from day one of your investing career put that 1% extra at work, you end up making 35% extra wealth by the end of your investing life. That's a huge amount of money. So the first misconception comes that why should I put money at risk just for 1% extra risk? The second misconception about debt is it's such a stark you know uh, extreme that when it comes to equity, and I see everyone invariably say that don't time the market, don't worry about the short term factors, don't worry about the valuations in the short term, etc., etc. And then when it comes to debt, people will always start with saying, so what's your view on interest rates? So there is a huge element of market timing when it comes to debt. Now, I don't want to overemphasize it, but you know that the uh, long-term return of debt in India is pretty much similar to the long-term equity returns, and it's the case now everywhere, because partly because of the technical fact that a lot of strength in the market is because of the extraordinarily loose monetary policy by the central banks. But even ignoring that, the point I'm trying to uh, uh, emphasize is that there is a huge emphasis on market timing. And then what actually ends up happening in real life is that when interest rates are going up, then people typically say, look, I'll wait for a little while because the interest rates are going up, so I want to wait a little longer. And when interest rates are coming down, then most often the reaction is, look, it's already fallen too much, so how much more the interest rates can fall, and therefore people hold back investing. So when interest rates are going up, they wait for it to go further higher, and when they're going down, they think it has been too much. And in the process, what we have seen, I mean, we have seen one of the most spectacular rally in the fixed income in the last 3 years. And we have not seen even 5-10 crores come into bond funds in a meaningful way. It's only in the last 6 months that we have seen a huge inflow into the banking PSU funds and the corporate bond funds. And my final point on the debt is that when you are investing in equity, you are investing for growth, because that's where your returns will come. You may invest in a very solid company, but if the company doesn't grow at a rate higher than the cost of your capital or the GDP, then it will not outperform the market. But when you are investing in debt, you are concerned with the solid cash flows of the company's ability to repay the money that it has borrowed. So when you are investing in equity, you are focusing on the growth prospects of the company. Obviously, you look at other factors which will support that growth, whether it is the management quality, business quality, so on, the moat, as people say. But when you are investing in debt, your focus should be on the solvency. So the growth is what you look at when you invest in equity. The solvency of the company is what you look at when you are investing in debt. I think that is the one single factor which is the most noticeable and most important difference between equity investing and debt investing. Because if you look at the history of the mutual funds in India, at least I can talk about that with some understanding and knowledge. Every fund that has seen a problem is on account of debt. In equity, you can make thousand mistakes and still survive. In debt, one mistake can be fatal. So, if you were to rephrase this, you say when you are investing in a portfolio of equity stocks, your hope and pray is that if one out of that turns out to be a multi-bagger, then you will have made your wealth. Whereas in debt, it is just the opposite. If you have one credit accident, and you will have completely wiped out your returns, if not capital. So I think the one factor which I cannot emphasize enough on is the credit quality. If you are investing in high credit quality portfolio, interest rates are cyclical in nature. As long as you remain invested for one complete interest rate cycle, history will suggest that you will end up with something like double digit returns if you choose the right fund. So let me take a pause at this point and see whether I am in flow with the direction that you want me to go to. Thank you.
Absolutely, you are completely in the flow, and in fact, not just in the flow, you have given us actually more than what we were looking out for. So, which brings me to my next question, Mahendra. See, generally, when I talk to investors, all right, and we keep emphasizing on the importance of fixed income investing, the importance of debt investing, एंड आई कीप गेटिंग अ कॉमन रिएक्शन, यार ये सब तो हम सुनते ही आ रहे हैं कि डेट इन्वेस्टिंग जरूरी है, पर ये काम कैसे करता है, ये कैसे हम चूज कैसे करें सही डेट म्यूचुअल फंड, हमें समझ में भी नहीं आता कि कोई अल्ट्रा शॉर्ट फंड होता है, कोई शॉर्ट टर्म फंड होता है, कोई कोई गिल्ट फंड होता है. तो एज अ ले इन्वेस्टर, इवन इफ आई वांट टू टेक माय फर्स्ट स्टेप इन्वेस्टिंग इनटू डेट, the terminology is used in the category itself is so intimidating कि मेरी हिम्मत ही नहीं होती कि चॉइस बनाने की उसमें से. So I want you to share your thoughts on. चलिए कैटेगरी तो सूटेबिलिटी का विषय हो गया, ठीक है, पीपल नीड टू सी व्हाट सूट्स देयर रिक्वायरमेंट, बट इफ इट इज नॉट फॉर सूटेबिलिटी, व्हाट आर द एलिमेंट्स दैट वन शुड लुक आउट फॉर while selecting the debt fund or debt category of choice? What are the key elements that goes into selecting a good fund for your portfolio?
Yeah, I think again it's a very, very relevant question because when we interact with so many people, we get pretty much similar kind of feedback that people find that to be very complex subject, which perhaps it is, not because the subject of debt is so complicated, but because I think debt is largely an institutional business, and most of the trading or the market volume or the outstanding investments are with institutional players. So it's something like, people don't pay that much attention to the debt. And as I said in my opening comments, that as the investor awareness increases, those focus will come. So uh, there are two very important developments that have happened in the last couple of years. One is that SEBI has now done the categorization of the scheme, so it is very easy to see which scheme has what flavor and what is the risk profile of that scheme. And very soon, I think from this month, we will also have something called a riskometer. So within the portfolio, if there are nuances in terms of the differential credit quality or different levels of liquidity or the interest rate risk, that will reflect riskometer score. So the conventional way of analyzing a debt portfolio by going by the credit rating or by the nomenclature of the fund or by a value research or a Morningstar rating, I think that will evolve and it will become easy for the investors to identify the fund's risk profile uh, combined in the riskometer score on account of liquidity, credit, and the interest rate risk. But beyond that, I want to say that sometimes we make the debt investing a little more complicated than it is. So I think the art of investing is to make complex things simple, and the only way to do is to do simple things in a simple way. So, as I said, in my long experience, uh, most of the people have had problem on the debt side, primarily on account of one of the two factors. First is they were trying to time the market, and they were trying to predict interest rates trajectory. I think God will find it very difficult to do. We are the mortal humans. And the second is, which is where I think the most of the pain has come, that people invest in the debt not to maximize the return by taking the appropriate risk, but by trying to improve the return on the corresponding fixed deposits or the tax-free bonds by a few basis points by taking the higher credit risk. Now, there is one simple thing that we need to understand, that if you are trying to generate a return which is a few basis points higher than the bank FDs. In the process, somewhere one ends up making a portfolio like a bank because he's trying to give a return profile of a bank FD. And the only thing we know about banks is NPAs. So when you hit a credit accident, then it can potentially wipe out your returns of a few years. As I said, that in equity, your objective is to get one investment right, which is a multi-bagger, whereas in debt, your objective is to avoid one mistake because it can be fatal. And in the last 3 years, there are multiple examples where things have gone wrong big time on account of credit. So I don't need to take individual names. So I think the most important thing, therefore, is to focus on three things. One is when you are investing in debt, you need to maximize your return. Your objective of investing should be to maximize your return. The return maximization comes from a product which gives you market related return. Debt mutual funds are the only one which gives you market related return, because when interest rates go up, bond funds give 15% return. When interest rates go up, they obviously give a low return for a few uh, uh, days or months or years. So I think the trick to avoid that disappointment and end up with a double digit return is to make sure that your investment horizon is at least one full interest rate cycle. So if you look at 2018 to 2020, if you look at 2016 to 2018, typically we have 2 to 3 years of an interest rate cycle. Second is to avoid credit risk at any cost. Now, I'm not saying that you don't buy anything apart from T-bills or government bonds, but basically don't invest in a high risk company because you want a high return. That equation has not paid off. And the third is that match your risk profile with your investment horizon, with your risk appetite. There is no free lunch. So in debt fund, there are two main sources of return. One is duration, the other is the credit risk. And I have repeatedly said credit risk is not something that you want to attack. So take duration risk, accept the volatility in NAV, let the NAV go down. When interest rates go up, your NAV goes down, but the fund manager invests new money with a at a higher rate. So just make sure that you are invested for one full interest rate cycle or the investment horizon of the fund. That will make for a very good debt mutual fund experience for any investor.
Right. So, during this second bit of the conversation, quite on and off, you touched upon a few critical elements when it comes to debt investing. You specifically mentioned that mistakes are going to be really costly when it comes to debt investing. So, obviously, you have touched upon it in bits and pieces, but I wanted to dedicate one question to you specifically around what are the risks that debt funds run? Okay. So, what are the risks, and how should an investor look at it? Should it be a deterrent, or should an investor view it from a mitigation standpoint? What are the risks, and how should an investor be comfortable with it and yet go ahead with that investing?
Yeah, sure. So uh, we discussed at the beginning that people find the debt a little bit complicated. I believe largely because of the non-familiarity and because of not spending enough time. So I tried to avoid some of the technical terms. But let me just say that you can divide the debt investment universe largely in two parts. The fixed income instruments like which are fixed rate, basically a bank FD or a tax-free bond, and that has been the traditional option that the investors have chosen by large measure. I mean, you look at the bank fixed deposit outstanding and then the debt mutual fund AUM. There is no comparison. Now, the risk of investing in a bank FD or in a tax-free bond is to miss out on the market participation, right? As I said, that when you are investing in debt, and for a typical Indian investor, for all the noise around equity, the typical allocation to debt is still around 60 to 65% of the portfolio. And as I said, if you get 1% extra return, the you know the terminal wealth can be very different. So it's not risk as in the risk of in the sense of risk that we understand, but not choosing the right option is one of the risk in debt. So one has to choose the right option, but that's a subject for a subsequent time. But let me now just say there are three major risks in any debt fund. One is the credit risk, the other is the interest rate risk, and the third is the liquidity risk. Now, credit risk, obviously, if any of the company in which the fund has invested, if that company has an unfortunate situation and if they delay or default, then I think the NAV will suffer significantly. The interest rate risk is the risk of interest rates going up while the investor is invested, and that can pull down the NAV of the fund, which means the returns of the investors can be low or negative. And finally, the liquidity risk is when the secondary market exit option for the fund managers are very poor, either because of a systemic uh, situation, for example, something like we had when the COVID broke out, or if the particular security is downgraded or for some reason there is no secondary market in that security. So in those situations, if the investor wants to exit, let's say for example we had a very tough situation with DHFL 2 years back, and then over a period of time DHFL situation unfortunately continued to deteriorate. Now, even much before the eventual default in case of DHFL, one could sense that there is something not going right with the company and you want to exit, but then there is no secondary market, so you can't exit. So that is the illiquidity risk, where you understand that things are not going in my favor, but at times it is difficult to take an exit. So people need to be mindful of how the portfolio is distributed in terms of interest rate risk, the credit risk, and the illiquidity risk. Now, when you are investing in a mutual fund, largely the liquidity risk is well managed historically by the mutual funds. There are a few cases where there is a temporary liquidity strain, but I think by and large the industry has done a great job. Credit risk is where the problem is with the fund manager most of the time, and the interest rate risk. Can you hear me?
Yes, I can. Yes, I can. I just got disconnected for a bit. Now I can. Can you hear me?
Nirav, can you hear me?
Yes, I can hear you. Yes, yes. Hear you. Can you hear me? Oh.
Okay. So, therefore, I think the investors have to be careful about the portfolio quality. When they invest, they should ensure that the credit quality of the portfolio is acceptable to them. And as far as the interest rate risk is concerned, my view is that if the investors have a long enough investment horizon, that should not be worrying them. So I think the risks in debt fund are the credit, liquidity, and interest rate risk, and there are well-defined ways to deal with each of them.
Right.
Thank
Right.
you.
So, can you hear me? Am I audible? Can you hear me? Just give me a moment. Yeah. So the next question is around a very important topic. And investors keep worrying and keep arguing on this. The question is that there are two sides to this concept of running an SIP into debt funds. Okay. So, what do you think? Is it a smart thing to run an SIP into debt funds? So, one school of thought says that running an SIP into debt funds does not make sense because you miss out on the coupons just by waiting for your next SIP installment to be deducted. And one school of thought says that like the interest rate cycle moves, you get to average out. So, what's your thoughts?
Yeah.
Am I audible? Can you hear me?
Yes. Yes. You are.
Yeah. So, so let me just reiterate the question. So there's this very important question that investors keep asking each other and keep asking the advisors. The question is around SIPs into debt funds. So there is one school of thought that says that an SIP into a debt fund does not necessarily make sense because while you're waiting for the next SIP to be triggered, you lose out on the coupon without gaining any incremental marginal benefit. But the other school of thought says that, hey, just like equities have a market cycle, even debt funds undergo an interest rate cycle. And so why not average your cost even in debt funds? Okay, and there's an entire different third school of thought that says that it's not about cycles, it's not about coupons, it's about investing discipline. As long as you're maintaining an asset allocation at the time of deployment, investing in debt funds through an SIP also makes complete sense. So, what's your take on investing in debt funds through SIPs?
Yeah. So as we discussed at the beginning of the discussion, that there is an investing part and then there is a debt investing and equity investing. Same concept applies with SIP. Now, SIP is not something patented by the equities. SIP is a financial discipline or it's a financial function. So SIP is, in simple terms, it's an cost averaging mechanism. So let me just give you a simple example of how the SIP works in equity versus the SIP works in debt. Now I don't have obviously the uh, flexibility right now to share my screen, so let me just try to describe it. Let's say you are doing an SIP in equity scheme, and then let's say at the start of the SIP the Nifty is at 10,000. So your first installment goes, then the Nifty goes to 9,000, your second installment goes, and so on. And Nifty comes to 6,000, and you made five installments. Your weighted average cost is something around 7 and let's say 8,000 of Nifty. And then Nifty starts going up. You again buy at 7,000, then at 8,000. Now your cost is somewhere around 7, somewhere between 7,500 to 8,000. Then Nifty goes up. So once Nifty comes back from 6 to 8,000, you break even. Nifty comes back to 10,000 from where you started investing, you are already in money. And then Nifty goes to 12,500 or 14,000 as it is now, you make huge amount of money. And then you feel very happy. Now, if you put the same example to the SIP in debt, let's say you start investing when the 10-year interest rate is around 6%, which let's say it is now. It goes from 6 to 6 quarter. Your next installment goes, then 6 half, 675, and 7, and so on. Now, by the time you made your fifth or sixth installment, let's say 10 year is at 7%, your weighted average holding cost is 6.5%. Now, it comes back to 675, you make one more SIP, it comes to 6.5, already you are at break even, much like you were at break even in Nifty with a starting point of 10,000 and reversal point of 8,000. Interest rates again come back to 6 quarter, you start making money. it comes back to 6%, you make a huge amount of money. That's where you get your 10, 12, 15% return in debt. Now, that's where, the SIP works in debt funds exactly the same way as it works in the equity fund. There is absolutely no difference, because SIP is just a mechanism, it's a financial function. Now, uh, people don't pay that much of granular attention to how it works. People are still struggling, in my view, to understand debt mutual funds. There are few experts like you who will try and explain to investors, but I again will reiterate that it's the overwhelming fear factor that holds them back from using the same techniques. Because in equity, I mean, if you take the SIP out of the equity market today, there is no other technique people understand about equity. And if they do it in debt, we did it, we uh, advised the same thing to our investors when we launched our dynamic bond fund. And then in 2018, there was trouble. So we calculated my dynamic bond fund return lump sum was something like 11.5%, and the SIP return was something close to 18, 19%. Now, that was obviously an extreme example because the interest rates moved very, very fast during that time. But I think that SIP is just a financial function, and therefore it is applicable as much there in debt as much in equity or in gold. Because if you remember, I mean, there is a way to look at it. The longest uh, SIP any average Indian has done in his family tree is in gold, because every Dhanteras we buy a little bit of gold. That is the SIP in gold. Then you see the banks, the post office deposits, especially the post office or the small savings. The highest percentage of the small savings in the bank, post office, etc., is recurring deposit. That is an SIP. Now, that is obviously a fixed rate SIP, unlike mutual funds, because mutual funds also give you the benefit of participating in the market movement. So I think SIP is already the most popular across asset classes in our Indian system.
Right, right. I feel you made a very critical point there around the concept of SIPs. So the SIP is a deployment method, right? It is nothing more than that. And at the very outset, you said one thing very important. SIP is not a methodology patented by equities only. Okay, so it is a fundamental concept that can apply across asset classes. Gold, debt, equity, no matter what, the underlying principle is to average the cost across cycles, and it does the same efficiently when it comes to debt investing as well. So I feel that's a very great point to make, and that is something that our investors must also take note of, and hence I reiterated this entire thing. So now coming to the juiciest bit of uh, of the conversation, wherein people are looking forward to hearing from you. आज क्या करना चाहिए? Today, if I want to take a tactical call into debt investing, I call it tactical because his horizon, etc., could be anything. But considering there's a tactical call being played, trying to maximize on the current interest rate situation and the current macroeconomic environment, what according to you is a good category to look at, or what according to you is the sweet spot on the duration?
So at this point, if you look at the macroeconomic environment, I think let me get a little bit technical, because that's the
No problem, please.
simplest way to explain this. You look at the last 1 year now, maybe 10 months, but let's say practically 1 year. RBI has been on an extraordinary monetary policy stance, but largely for two reasons. One is that the COVID disrupted everything, and then COVID obviously had a very negative impact on the economy. So RBI wanted to ensure that the nascent recovery that we now have post the stabilization in COVID is continued to be supported. Now, in the interim period, unfortunately, inflation went up, and then they said it is because of the disruption in supplies, etc., etc. But the headline number went to as high as 7.5% plus. Now it is back to around 460, but the core inflation is still around 575, which is very close to the RBI's target band of 4 to 6%, so at the higher end of it. Therefore, the food and the vegetables cannot any longer be attributed to this high inflation. Now, you look at the last 10 months, RBI was maintaining an extraordinarily loose monetary policy because of the COVID disruption and the poor economic prospect. Now, as we know today, the COVID situation has improved significantly, especially as far as India is concerned, from a high of about a lakh cases per day and a total cumulative case count of about 10 lakhs in September. Today, the daily new case count has come to below 20,000, and the cumulative case count has fallen to close to about 1,70,000 last number I saw. Therefore, there is a significant improvement in COVID situation. The vaccines have come now. Therefore, we can expect further control on the COVID spread. Economy, after collapsing by about 24% in Q2 of FY21, which is period ending June, and then by another, close to 9% in Q3. Now the economy in this quarter, that is the quarter ending December, in my view, has already done better than the corresponding quarter of December 2019. And in the current quarter, which is the March quarter, I think the economy will post a growth of about 5-6%. The government was facing a huge challenge on account of the shortfall in the revenue, which was largely driven by the tax collection shortfall. Now, we have seen a significant improvement in the collections on account of GST. Now, you will need to appreciate that even before COVID, the GST collection rate was slowing down. Now, in my view, that was primarily because of the challenges faced by the auto sector. So, if you recall that even in December of 19 and March of 20, the Marutis and the Hyundais were posting 25% decline in the auto numbers. And now suddenly Maruti and all these guys have a waiting period of 4-5 months. They have taken two price hikes. Now, what is the connection with the GST here? It's simple that auto has the highest tax slab for the GST, the slab, sin rate, and therefore an improvement and bounce in the auto sector is directly exhibited in the GST collection numbers in the last 2-3 months. Economy is now projected to grow at about 11% in FY22. Now, why this is relevant is because if RBI was following an extraordinarily loose policy because of COVID and economy, and both things are now visibly on a sustainable recovery path, the reason for the RBI to follow an ultra loose monetary policy does not exist anymore. Therefore, the RBI will have to, over a period of time, move towards normalizing the monetary policy, and they have already taken the first step. Last 2 fortnights we have seen the reverse repo uh, with a flexible rate. So therefore there are telltale signs of the interest rates having been bottomed out. How far they will go up, because still the economy, as I said, recovery is in early stage. So the RBI will continue to intervene through OMOs and Operation Twist and not allow the interest rates to spike in a meaningful way. But then today's economic survey already told you that the government is planning to go a little bit, easy with the fiscal deficit, because they had already said that we will uh, go for a, front foot play when the COVID situation improves. So I think there is every element suggesting that interest rates possibly have bottomed out and are likely to go up. So in that background, I think just So in that background, I think one has to be a little bit defensive, taking a tactical call on the interest rates. So if I am taking an interest rate call right now, I will possibly be a little defensive. Therefore, I'll possibly focus on the low duration category. Now, why the low duration category is because interest rates may have bottomed out, but still there isn't any reason to believe that they will spike up meaningfully because of the RBI's intent to keep them in a control. And look, the global environment is very benign. All the central banks globally are committed to more and more easing. Therefore, the Reserve Bank has a strong tailwind of the global monetary policy support that will allow them to keep the interest rates under check. And the FPI flows, the FDI flows continue in a huge gush. we got about $100 billion increase in the forex reserve. So that gives the Reserve Bank another challenge. On one hand, it is a again extra elbow room because the liquidity in the system is good. But the challenge is that if you start sterilizing that kind of liquidity, then the signaling to the market could be very, very different than what is intended. So therefore, if you are looking at the next 6 months to 1 year where there is no clear direction for the interest rates, the interest rates remain range bound where the market does not have the tailwind of fundamentals to take interest rates lower, but the Reserve Bank will intervene and not allow them to go up, then if you are in the low duration fund, which has a maximum duration of 1 year, then by the end of the year, most of the investments will mature. So even if there is a unexpected but sharp spike in the rates, it will possibly unwind itself and flow back into NAP by end of the year. If the interest rates do not go down, do not go up, then you get an extra carry on the curve. So I feel that the low duration, from a technical perspective, is perhaps the most desirable place to be right now. But again, as I said in the beginning, my experience very humbly is that whoever has tried to done this market timing has not worked. So if the investor has a full interest rate cycle investment horizon, which means around 3 years, then he should invest in a bond fund, in a banking PSU fund, where if the interest rates go up, the fund managers will be able to invest the new money at a higher rate. And then when, let's say in a year or year half time, when the interest rate environment improves, interest rates come down, they will end up with 10% kind of returns in 3 years time. Thank you.
Right, right. Very well put. In fact, very elaborate response to a rather simple question. I feel there's a lot that our investors should take note of from this response that you've shared. As we move towards the fag end of the session, Mahendra, we would love to take a couple of questions from our audience. So the comment section is abuzz with questions. Okay, people are thoroughly enjoying this conversation. They are continuously interacting with us, but in the interest of time I will be picking only the top 2 or 3 questions in the interest of time. So the first question, Mahendra, is that I can see good returns in my debt portfolio. Is it a good time to book profits and exit?
Well, it's like if I own a house and where the prices have gone up, do I sell the house and go to stay on rent, right? Yeah, so it depends on how long the investor wants to be. So I always give this example, my own example, that look, I am a salaried person. I'm about 50 years. I have with most of my responsibilities in life. I don't have any debt, and possibly if I do a good job, I will retain this job for another 10 years. So I will have some surplus every month. Now, if I take out, where do I go? So I keep on adding to do an SIP kind of thing in debt every year. Now, obviously, if the interest rates go up, it will have a dent in my portfolio. It will reduce the HPR of my portfolio. But then, if I'm going to remain invested for, say, next 3 years, where the next interest rate cycle will be completed, my HPR will again cross 10% in next year's time. So, therefore, there is no straight answer to this. It depends on what is the investor's investment objective. Like we discussed, if he is going to take a tactical call, then maybe he will switch out to a low duration fund, which is my recommendation for a tactical call. But I must warn, and I can't emphasize it enough, that in my experience of 25 years, every time anyone has tried to do this, it has not worked. Let us be very clear that, look, you go out and stand on at Dadar station, or Bombay Central, and then you will see thousands of people come to Bombay every day to make their mark in the movie field. And then you see there is one Akshay Kumar, one Shahrukh Khan, one Salman Khan. For last 20 years they are ruling the roost. You look at cricket, go to Shivaji Park, and you will see guys slogging it out at 6 o'clock in the morning. But there is one Tendulkar or one, Dhoni or one Virat Kohli who have made big money out of cricket. Then you narrow your focus and look at the investment world, there is one Rakesh Jhunjhunwala or one Ramesh Damani. So I think if someone is that exceptionally smart and talented, it works. But our experience is just like equity, remain invested, don't worry about the short term trends, invest, look at the investments, review them on a interest rate cycle to interest rate cycle basis. That's the best way, because by not shifting you also save on tax. So if you remain invested for long period, you not only save tax, you also reinvest your tax, which, let's say if you have invested in FD, whether you invested in FD for 5 year or 10 year, every year the bank will deduct TDS on your interest and pay to the government. So the amount you reinvest is lesser. Now, Mr. Warren Buffett has given us the magic of power of compounding. We have worked this out, pre post tax. There's a huge difference between the same money invested for 10 years between, say, FD or any investment which is taxed versus where even the tax amount is reinvested. So that is one part. The second part is that, look, and this is very important. I think we must understand this. Someone who invested in 2018 and his HPR today is 10%. Now, even if the interest rates go up by 1% from here, maybe his HPR will come from 10 to 9 or maybe 8 half. Now, when he invested, he would have been very happy getting 8%. So today, by remaining invested, his ability to absorb an interest rate shock has improved tremendously. Therefore, I think the best option is to think in terms of the where I started. I bought a house and the price is doubled. Do I go and rent and hope for a market correction in property and come back when the price is fallen? Possibly not. Nothing is different in case of anything, whether it is debt, equity, gold, or anything. The investment objective, the investment horizon, the risk profile, that will give the answer in a specific case.
Right. Right. So, very interesting perspectives on it. The next question from our investor is, Sir, we see that you are a strong proponent of banking and PSU debt funds. What makes you think that banking and PSU debt funds are a stronger bet versus most other debt categories?
Yeah, so let me just clarify. I am not a proponent of any category because each category has its own pros and cons. But if you look at the banking PSU, I mean, repeatedly we spoke about two features. One is that we have to avoid aggressive credit. So banking PSU by definition avoids, the aggressive credit. So if you look at the banking papers, typically the banks are all PSU banks are supported by the government, therefore their financials don't matter, the performance doesn't matter, because our basic faith there is name lending, because we know that the government will bail them out. Until that view changes, PSU banks are safe. And then private sector banks, the top three or four of them are, again equally strong. And then you look at the PSUs, again the basic thought process is name lending in the name of the government. So therefore the credit quality by default is taken care of, even though some fund manager may want to go aggressive or not. Now there is another aspect of debt which I did not touch because either the occasion did not, the context did not allow, or I did not want to get too technical. But let me just make a very simple point that in equities, you choose the right stock and remain invested, and company makes the money and you enjoy the wealth. Which means, let's say you take example of Maruti, and once you have invested in Maruti, you don't have to do anything because it is the Maruti which will manufacture cars every day. They will ship it, they will sell it, they will make profit. And then all you need to understand that from what Maruti is doing, what is the fair value of the stock, and whether the market price of the stock is higher than the fair value or lower than the fair value. And then so you don't have to do anything once you've invested in equity. In debt, it is just exactly the opposite. If you don't do anything, at the end of 10 years, you'll get the coupon that you started with. But we know that interest rates are very volatile. Every year, the gap between the high and the low of 10 year is close to 100 basis points plus, which is a lot of money. So we have to have a flexible investment strategy where you can recalibrate the duration of your fund. Now, banking PSU fund is one category where the SEBI has not given any duration range. It's open ended. So the fund manager can have a duration of 6 months or he can have a duration of 10 years. So therefore, the maximum value addition can happen if you have a good fund manager who is having a flexible investment strategy in that category. Therefore, let's say in our case, in our banking and PSU fund, we have largely targeted a duration range of 2 to 5 years. So then, when we think that interest rates are going up, we will take the duration closer to 2 years, which is the situation perhaps now. And let's say in 6 months or 1 year, whenever the interest rate environment improves, or when the market has priced in all the negatives, that time we can take the duration close to 5 years, and that is how we hope to deliver 10% plus return over a 3 year plus horizon. So therefore, banking PSU takes all the requirements in terms of the flexibility of duration, in terms of the credit quality of portfolio, etc. And therefore, I think that's a good category to invest. But again, I have no strong views on any category. I think Nirav, you guys the experts. You guys are the expert to tell that we are manufacturer. We just do everything. So, आपको uh, you know whether you want to buy the top end model, mid end model, low end model, for me a sell is a sell. It's you people who are the expert in advising the right product.
Absolutely, I feel our collaborative efforts is what makes us great as an industry. The way manufacturers and distributors work so cohesively, exchange knowledge. Like this very session, you're right. We make portfolios, but without listening to your part of the story, I don't think we have even started with our journey to expertise, right? So it is from what you share with us that we start developing thoughts. So, a very great point made. And as we move towards the fag end of our session, um, you know, there's this one question that has come up. It is slightly technical. I was wondering whether we should ask it or not, but whether everyone will understand. But since it sounds interesting, let me give it a shot. And we would love to hear your thoughts on this question. So here's it. Dear sir, through repo operations and OMOs, we see RBI sucking out short-term liquidity and releasing longer-term liquidity. This could possibly lead to softening of long-term yields. Is this the right way to interpret RBI actions? And if it is, do you think there is an opportunity in taking exposure to longer duration yields?
So, look, there are two technical terms in the fixed income world. One is called the bull steepening of the yield curve, and the other is called the bear flattening of the yield curve. Now,
Right.
if the inflation is expected to remain high, if the excess liquidity is likely to moderate, and then if the supply of the bonds, because of the fiscal deficit, and because when the economy recovers, the corporate sector will also need a lot more capital, whether for capex or working capital. So at this point, we are looking at a scenario where there is excess liquidity, which is not being put to the productive use, because there is no great demand in the system, because the economy is in docks. And then uh, RBI is also on an extraordinarily loose monetary policy to address the extraordinary situation. So when the situation normalizes, my outlook for 2021 was that it's all about how the Reserve Bank normalizes the monetary policy. So most likely scenario is that the liquidity moderates and the short-term rates move up, which is what we call a bull flattening of the bear flattening of the yield curve, which means the short-term rates will go up. It will not result in the long-term rates coming down necessarily at this stage. Obviously, if the inflation crashes, or if you have a strong second wave, all those things can happen. Please remember that even at the best of times for fixed income in August, September, 10-year did not come below 575. So I would not put too much hope on that. And please also understand, I'll give you a very simple, analogy that if you people are aware with the standard measurement of where the Fed is in US, it's about the spread between 2 to 10, right? And then
Right.
it's not only in the equity market that the traders move ahead of the corporate actions, but in fixed income also. So therefore, typically the Fed interest rates will have peaked when the yield curve is flat, which means the 2-10 spread is zero, the 2-year yield and the 10-year yield is same, and that's where the Fed starts cutting the interest rates. Now you see last year the 2-10 spread was next to zero, and then the Fed cut big time. Similarly, if we believe today that 10-year yield is going to go up or interest rates are going to go up, we are not going to wait for RBI to announce that okay, today there is a rate hike. I mean, we will sell before that. So therefore, the 10-year will already have gone up. And if now the Reserve Bank starts normalizing the monetary policy, which means the short-term rates go up, the most likely scenario in a benign move is for 10-year to remain stable and short-term rates to gradually go up. And just my last point on this very technical perspective, that for the last any number of years that I have been in the market, let's say last 5-10 years, our systemic liquidity was always negative, which means the banks were always borrowing from the Reserve Bank in the repo market, and therefore we had a very unique curve where the yield curve from 0 to 1 or 2 year was very steep. Let's say the repo rate is 6%, and then the 1 year T-bill is 7.5%, and then 2 to 10 year was always flat. So the difference between 2 year and 10-year yield curve was maybe 50 basis points or so. The whole curve is in within 100 basis points. Now, this is for the first time because of the combination of the excessive liquidity injection by the Reserve Bank by way of the CRR cut, LTRO, TLTRO, and so on, but more because of the $100 billion of the forex flows because of the, let's say, geo FDI investment or the gush of the foreign portfolio flows in the October, November, December, that our system liquidity is now in surplus by about 6 lakh crores. This is the highest that we have ever seen. And now you were in an environment where nobody trusted that interest rates will go down because the inflation was high. So you had a very unique situation. For the first time, we saw such a steep yield curve where the, let's say, 3 month is at 3.5%, the 1 year is at 4%, 3 year is at 4.75, and 5 year at say 5 quarter, then 10 year at, so the curve was very flat starting from 5 years or maybe even 7 years. Now, therefore, obviously, when that situation changes and the liquidity goes down, you should expect short-term rates to go up more than the long-term rates to come down. I hope it wasn't too long an answer, but I thought let me just give the 360-degree perspective on this.
No. In fact, I wouldn't call it long. I would call it comprehensive. In fact, it was a comprehensive response. I feel, to the guy who asked this question, this would have answered, what he was actually looking out for. So Mahendra, we come towards the fag end of this conversation. It has been a beautiful conversation. As I said, this is our inaugural session on debt. There are many more to come, but I'm just really glad that we had you start the series on creating awareness and education around debt investing. So it was a beautiful conversation. I thoroughly enjoyed it, and I'm sure our viewers enjoyed it. Guys, I know there are a lot many questions that I haven't asked, but feel free to write to research@fisdom.com, and my team here will help respond to each one of it. Back to the conversation, Mahendra. Thanks a lot for your time today. It has been a pleasure hosting you on the Fisdom webcast.
So thank you very much once again. Thank you for giving me this opportunity. And I will once again conclude by saying that please, whatever I have said on this last 1 hour, please read it in together with the disclaimers and disclosures in our scheme offer documents and the website, because we are supposed to uh, be very constrained in what we say, and therefore, if there is anything, it should be interpreted along with that. Thank you very much once again, and my best wishes for the budget and the monetary policy, which is due next week.
Thank you, Mahendra. It was a good conversation.
Thank you.
So, guys, that was Mahendra Jajoo, the CIO of Mirae Asset Investment Managers. So, guys, this is our inaugural session on debt. I know I've repeated it quite a number of times, but the reason I call it inaugural is because this is the first of many. There are a lot many more sessions wherein we are going to cover a variety of topics. We are taking your feedback. A lot many of you wrote to us, you wanted a session on debt, and this is just the beginning. Okay, we are going to have a lot more around debt, around commodities, around a variety of topics. I am leaving a few to retain the element of surprise, but just to summarize this conversation that we've had with Mahendra, the idea is simple. Debt investment is important. No matter what you think, SIP is not just to be done into equities. There is a fundamental reason why SIP is a great concept, and everyone in the industry love it. It is the rupee averaging concept, and it works for debt as well. Just like markets have cycles, even interest rates have cycles. And also more than anything else, it helps you stick as close to your asset allocation as possible if you maintain an asset allocation including debt during each of your SIP deployments. It makes complete sense. Do not get misled by the terminology called fixed income. There is a reason why it is called fixed income, but the reason is not because you are going to get an assured income. There are risks inherent to debt investing: credit risk, liquidity risk, duration risk. Now, I know for most of you this might be all Greek and Latin, but trust me, you can write to us and you need not worry about these risks. And you can leave the worry to us. Let us curate a portfolio for you into the debt space, which helps you mitigate and optimize these risks while you make good returns. So this was a great session on debt. Thanks a lot for your participation, everyone. Like I always say, the more you learn, the more you learn, and the more you share, the more you will learn. So all of this is correlated and goes without saying. You gotta share this with each and every one, because the more they learn and earn, good karma always comes back, right? So share it with everyone. Share this video with everyone. Don't forget to subscribe to the channel for continuous updates. I promise we are going to be back really, really soon with a really interesting topic. And don't forget to like and comment. So meanwhile, watch out. If for those who haven't downloaded the app, please download the Fisdom app and log into the app. Trust me, there are a whole lot more information and learning tools that we are going to be putting up on the app. And with the budget right around the corner, trust me, Fisdom is one app that you want to have on your phone to be in the know of whatever is happening in the budget. So meanwhile, guys, happy investing. See you around really soon with yet another interesting guest on yet another exciting episode of the Fisdom Wealthcast. Happy investing, guys. See you around soon.